Ready to pass the CPA exam faster? Visit cpapass.ai. Today, Treasury stock accounting cost method transactions. Many CPA candidates lose easy points on the fair exam by misclassifying Treasury stock or falling into the income statement trap. Treasury stock represents a corporation's own shares that it has repurchased from investors. Under the cost method, we record this transaction at its actual acquisition cost, completely ignoring the stock's original pair value. Crucially, Treasury stock is not an asset, it is a contra equity account that reduces total stockholders' equity. Today, we will break down how to handle buybacks and reissuances without accidentally recording a single dollar of gain or loss on your income statement. Let's look at the mechanics of the cost method. When a company buys back its own stock, we debit Treasury stock for the full purchase price paid to investors. For example, if Def Company repurchases 1,000 shares at $20 per share, we debit Treasury stock for $20,000 and credit cash for $20,000. Notice that we completely ignored the stock's par value here. This $20,000 debit balance acts as a direct reduction to total stockholders' equity. Remember, Treasury stock does not receive dividends, has no voting rights, and must never be shown as an asset on the balance sheet. What happens when we reissue these Treasury shares above their acquisition cost? Suppose we sell those $20 shares to new investors for $25. We debit cash for $25 per share. Next, we credit Treasury stock to remove the shares at their original cost of $20. The extra $5 is not a gain on the income statement. Instead, we credit additional paid-in capital from Treasury stock. This APIC account acts as an internal tracking system for the premium received, keeping these transactions entirely within the equity section and bypassing net income. Now let's tackle the examiner's favorite trap, reissuing Treasury stock below its cost. Suppose we reissue those $20 shares for only $15. We debit cash for $15. We must credit Treasury stock for the original $20 cost. To balance the entry, we need a $5 debit. Where does it go? First, we debit any existing APIC from Treasury stock from previous transactions. If that balance is zero or fully exhausted, the remaining loss is debited directly to retained earnings. This is the retained earnings debit bypass trap. We never debit an income statement loss account. The absolute golden rule of Treasury stock is that a corporation can never generate income or recognize a loss by trading in its own shares. The examiner will try to trick you by asking how a Treasury stock sale affects net income or retained earnings. Remember, the effect on net income is always zero. APIC serves as our internal gain tracking system, absorbing any premiums. When we sell below cost, we only reduce retained earnings if our APIC Treasury stock bucket is empty. Keep this wall between equity transactions and the income statement completely solid. Let's apply this with a practice walkthrough. Imagine a company buys back 100 shares at $30 each, then reissues them for $35. We debit cash for $3,500, credit Treasury stock for $3,000, and credit APIC Treasury stock for $500. Next, we reissue another 100 shares at $22. We debit cash for $2,200. We credit Treasury stock for $3,000. We debit our APIC Treasury stock account for the $500 maximum available and debit retained earnings for the remaining $300. Practice these steps on cpapass.ai to master this critical FAR topic.